In June of 2020, a truck company that had never sold a single truck was worth more than Ford. Its founder later went to prison. And millions of retail investors lost everything. This is how it happened. Between 2020 and 2021, Wall Street pulled off one of the greatest sleights of hand in modern market history. They took speculation, dressed it up in a shiny new acronym, and sold it to ordinary people as the future of investing. 613 companies went public this way in a single year. Most of them have lost 80 to 90% of their value. Today, we're unpacking what really happened. Because the warning signs were about to break down, they're showing up again right now. A SPAC stands for Special Purpose Acquisition Company. But let's translate that into plain English. A SPAC is a shell company. It has no business, no revenue, no products, nothing. It exists for one reason: to raise money from the public, then go shopping for a private company to merge with. Think about that for a second. You're handing over your money before anyone knows what they're buying. It's like writing a blank check to a stranger at a bar and trusting them to spend it wisely. Now, SPACs have existed for decades. They were a backwater. Considered a last resort for companies that couldn't pass the scrutiny of a traditional IPO. But in 2020, something changed. The number of SPAC IPOs exploded, from 59 in 2019, to 248 in 2020, to 613 in 2021. That's over $160 billion raised in a single year. For shell companies. With nothing in them. So what was the catalyst? And more importantly, who was really profiting? That's where this story gets dark. Let me tell you about a company called Nikola. In June of 2020, Nikola merged with a SPAC and went public. Its founder, Trevor Milton, promised the world a revolutionary hydrogen-powered semi-truck. Within days of listing, the stock hit $93.99. The market cap briefly topped $34 billion. More than Ford. More than a 117-year-old American automaker that actually, makes trucks. Then on September 10, 2020, a research firm called Hindenburg published a report calling Nikola an intricate fraud. The viral video of their flagship truck? The one that appeared to be driving down a road? It was rolling downhill. With no engine. They had pushed it to the top of a slope and filmed it coasting. Trevor Milton was later convicted of securities fraud in 2022. The company? Today it's essentially worthless. Retail investors who bought at the peak lost everything. And here's the most painful part: the insiders who sponsored that SPAC? They walked away with millions. Because that's how SPACs are designed to work. The sponsors get roughly 20% of the shares, for almost nothing, regardless of whether the deal succeeds or collapses. Nikola wasn't a one-off. It was the template. And Wall Street, seeing retail investors eating it up, started mass-producing these deals. Celebrity backers became the lure. Former NBA stars. Hip-hop artists. Serial entrepreneurs. All sponsoring SPACs with flashy names and hype-fueled roadshows. One man, Chamath Palihapitiya, launched so many of them he earned the nickname, the SPAC King. His SPACs took companies like Clover Health and Virgin Galactic public. Virgin Galactic peaked at $62.80 in February of 2021. Today it trades for pocket change. Retail investors, the ones who trusted the celebrity, the hype, the projections, they held the bag. And here's what really got me about this era: the rules were different for SPACs. In a traditional IPO, companies can't publish wild future projections. It's illegal. But in a SPAC merger, they could. So you had pre-revenue startups projecting they'd be doing $10 billion in sales by 2025. Slide decks full of hockey stick forecasts. Total fantasy. And completely legal. Now here's where we zoom out. Because if you understand why the SPAC bubble happened, you understand every bubble. 1. Easy money. The Federal Reserve had slashed interest rates to zero. Trillions in stimulus flooded the economy. When money is that cheap, people take wild risks. They have to. Cash in the bank earns nothing. 2. Story over substance. SPACs didn't sell financials. They sold dreams. Electric trucks. Space tourism. The metaverse. Nobody asked about margins or free cash flow. They just wanted to believe. 3. And this is the one that gets people every single time. New acronyms replace old wisdom. SPAC. NFT. ICO. Every generation invents a fresh label for the same old behavior. Speculation. Dressed as innovation. Because if you called it what it was, a blank check for a shell company, nobody would buy it. Ben Graham, the father of value investing, warned us about this almost a century ago. He said the market is a voting machine in the short run, but a weighing machine in the long run. The SPAC bubble was pure voting. And the weighing, it's still happening today. Most SPACs are down more than 70% from their peaks. Here's what I want you to walk away with. When a new financial product emerges, and it's making everyone rich overnight, pause. Ask one question. What am I actually buying? Not the story. Not the projection. Not the celebrity endorsement. The business. The cash flows. The assets. If you can't answer that question in one clear sentence, you're not investing. You're speculating. And speculation is just gambling with extra steps. The SPAC bubble wasn't unique. It was just the 2020s version of the South Sea bubble, the Dutch tulips, the dot-com craze. Same movie. New costumes. Different acronym. So here's my question for you. What's the modern bubble you see forming right now? Drop it in the comments. I read every one, and the best ones shape future videos. If this gave you a sharper lens on how Wall Street really works, hit subscribe. We drop a new value investing lesson every single day. And tomorrow, we're tackling something that might make you uncomfortable. A financial mistake Warren Buffett himself admits he made, and what it can teach every one of us. Stay patient. Stay skeptical. I'll see you tomorrow.